Welcome to the April 27th, 2020 Advance Report for McGowanGroup clients and NetWorthRadio.com listeners. I'm Spencer McGowan, President, McGowanGroup, and your financial weatherman with a fast-paced tour of the global financial markets with guidance and good math going forward. Here's where we are. There's the coronavirus correction, which we've been covering on a Dow year-to-date basis. This green line is a resistance level. What does that mean? Well, companies clearly aren't going to get back to record earnings unless they're in medical or a special category like a Microsoft or an Amazon. But what is it that we can do to come out of this with record income and record profits? So I'm going to take you back through the crisis of 2003, 2008, and we're going to look at those recoveries as well as what worked better, faster, with correct math. And the theme of this week's program is actually getting paid to wait. That means compounding cash flow and using it to gain future advantage. How do we get back to record profits? We're about to cover the key strategies, but let's look at something first on equity. A lot of portfolios have 50% bonds. Well, bond yields are below 1% for the fixed income portions in most traditional portfolios. Now we go to the equity portion. When would the equity portion be back to record profits? And what are we going to do in the meantime? Let's look at this. This is the Great Recession and the crisis 2007 through 2013. Why are those dates up there? Well, the peak in the Dow and S&P was actually October of 2007. There's a huge decline surrounding the crisis. That's when the banking system was insolvent. And even though the banking system was insolvent and there were default rates of 10%, well, we still recovered in equity, but that is a long 5-year and 5-month period from peak to peak. And all you got during that period was the average dividend, which was somewhere around 2%. So to get back to a 2% return was 5 years and 5 months by this chart. How do we do better than that? Let's look at the tech wreck. This is going back to the year 2000. And we remember Y2K. Well, I guess the Y2K predictions were correct in part because you had the tech wreck. The NASDAQ went down 80%. Wow. And a lot of the NASDAQ companies are very popular today. However, let's look at how long it took. It took 7 years and 3 months to get back to even on the S&P 500, and that was about a 2% dividend along the way. Think about that. That's how long an equity portfolio takes to get back. And the fixed income portion for most portfolios would only be a 1% forward return with duration risk. Maybe a 2 or 3% return, but with duration risk. You know what the Federal Reserve action means? Potential future inflation. So how do we overcome that and enjoy record income in the meantime? We're not going to enjoy it here because we're looking at a T-bill this week that is still about 10 basis points. That means in May, those investors in cash are lucky to get 0. Well, that's going backwards. And especially if you're spending something out of the portfolio, you're degrading that each time. If you're in equity and your net yield is 1 or 2%, or the traditional fixed income analysis or allocation, like the Vanguard Total Bond Market, well, you're actually going to spend some principal if you're withdrawing 4% a year. What would be better? By the way, that's 1.2% on a 30-year treasury. If the yield goes to 2.2%, that 30-year treasury could lose 20% of its value. That means traditional 50-50 allocations are not likely to do well going forward, and it also means the recovery to record profits could take 5 years, 7 years. How do we do better? And how did we do better in 2003 and 2009 in a recovery that took less than a year? And how did we emerge with record income and forward returns that were impressive? Here's how we did it. This is the high yield short-term index. This is an indicator for the category where I'm leading. And I've got two categories I'll mention in the rest of the broadcast. One is just simply global lending, B-rated corporate loans and bonds. You can see what happened in the crisis. Oh my gosh, they went from par, which is 100, actually over par, down to 62 cents on the dollar, recovered to 95 cents. Why? The default rate there was about 10%, but it went very low. But it still paid income, and most people pay their bills. In the Depression, the default rate was about 20%, which would be this level. But notice how deep it went. That's called deleveraging. And we came out of it with 0% interest rates, which is exactly where we are now. Just a basket of loans and bonds, and in this case, we returned to about 95% of par. That was a 50% gain potential from the low while getting paid income that actually was double digits. Now we look at the supposed credit crisis of 2016, not much of a crisis, you still got paid. Boom. They took the high yield index. This means the expected defaults were huge. And we went below 70 cents on the dollar for a basket of well-managed bonds and loans. Wow, and we've already come back up to here, and now we're about here, 80 cents on the dollar. That would accommodate a depressionary default rate. It's not going to be that bad because of what the Fed has done and because of the accommodations that are going out. And of course, the stimulus package. Well, I wanted to cover what we did in 2008 and 9 that actually recovered faster to record profits, this line right here, and delivered forward returns in the double digits. From before the crisis till after the crisis, we got paid every month in this category. The global high yield was a 14% average return. Not without price risk, you can see it right here. But we got to compound that. We got to enjoy the advantages of having income to pay the bills and having some left over to reinvest. And the reinvested total return was 14%. Domestic high yield was 10%. That was the last crisis. That's a key part to the strategy, and it's our current biggest allocation. You should get your own plan customized for your liquidity needs, income, and a 2030 vision from McGowanGroup Asset Management. Simply go to NetWorthRadio.com, fill out the preliminary client questionnaire, and what you'll have is your own version of a plan based on real math, real income, and accommodating the current crisis in a way that investors can actually benefit from the current tragedy that we see in the economy. I'm Spencer McGowan, President, McGowan Group, and your financial weatherman. Thank you for joining us for this week's broadcast. Thank you for tuning in to our YouTube channel. I'm Spencer McGowan, President, McGowan Group, your financial weatherman. We sponsor each week NetWorthRadio.com broadcast that has the charts and graphs, many of which you saw today. We also sponsor this YouTube channel. Be sure to subscribe for fast breaking news, an alert when we post something in a market condition that may have changed. Our goal is to help you as an investor make the right decisions at the right time. And that's part of what this YouTube channel is about, as well as NetWorthRadio.com. I am well served with a team of 10 people, including myself. And that team that cares is actually made up of people who devoted to your net profits and your success, as well as excellence in service. If you want an educational experience to follow this up, get to NetWorthRadio.com, the McGowanGroup.com. Right here, we disclose our net client experience all the way back to 2001. What that includes, the bear market cycles of 02, 08, 2018, and the recoveries through the most recent quarter. That is true education of investors and exactly how our clients have done, disclosed right here. Further disclosures, value at risk of loss. Yes, investments are going to fluctuate. That's part of the reason for this broadcast. And that can actually work to your advantage. We'll build that into your plan. So I urge you to go to NetWorthRadio.com, fill out the preliminary client questionnaire, a free 1-hour brainstorming session by phone or at the Crescent in Dallas, and we will map out a multi-year plan for you and your family that's appropriate. Just because we talk about a security on this broadcast or any securities doesn't make it a recommendation for your portfolio until you have that written plan. Thank you for tuning in today, and we'll be back next week as your financial weatherman.